Hi, everyone. Before we get started, I need to disclose a personal conflict of interest. In this episode, we will discuss Lighter, a decentralized crypto exchange. I'm personally involved with Lighter in two ways. I've made a personal investment in the company, and I was an early participant in their private beta, which could result in me receiving an airdrop of tokens that have significant monetary value in the future. Those ties could create a potential bias in how I approach this conversation. That said, I invited today's guest on the podcast well before either of those things were true, and I also sourced many of the questions from independent third parties to help keep things fair and balanced. With that out of the way, Vlad, are you ready?
Yes.
All right, 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hofstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I'm joined by Vladimir Novakovsky, founder and CEO of Lighter, a decentralized crypto exchange. To kick off the conversation, we explore Lighter's three big design choices. It's built as a custom layer 2 on Ethereum, it relies on zero-knowledge circuits for proving transactions, and it runs with a private sequencer. Don't worry if that sounds like gibberish, Vlad explains it all. Each of those decisions comes with trade-offs, but also big potential advantages. We discuss why Ethereum remains the natural home for new rollups, from inheriting its security to tapping into DeFi's growing composability. We also break down what ZK circuits actually are, why they matter for trust and security in a derivatives exchange, and how they're verified in practice. From there, we tackle the business side. How do you bootstrap liquidity in a brand new decentralized exchange? Why Lighter went with an unusual fee model, and the key lessons learned during an extended private beta. Finally, we zoom out to the bigger picture. What might DeFi look like if composability really takes hold? Could specialized rollups like Lighter become the backbone of an on-chain financial system rather than just another venue for speculation? Please enjoy my conversation with Vlad Novakovsky. Vlad, welcome to the show. Thank you for joining me. I think by the time this episode airs, I'll have been chasing this interview for, a little over 6 months. I think when you and I first talked, it was sometime around early Q2 2025. So I'm glad we were able to make this happen. And I know things are accelerating for you guys quickly at Lighter. So thank you for taking the time out of your busy schedule to chat with me.
Thank you, Corey. Yeah, it's been great getting to know you and showing you the platform over the last few months.
So let's start a little bit with your personal and professional journey that's led up to Lighter. I know, for example, you started a little bit in TradFi, you found yourself out in Silicon Valley. Walk me through the process and how things congealed ultimately into the development of this platform.
Yeah, so I think the starting point here is doing trading in TradFi, going back to the early days of Citadel. When I joined there, that was right when Citadel was getting into high-frequency trading, and I was academically doing a lot of math, physics, computer science, economics. So I was actually exploring some trading stuff on my own, and then when I joined Citadel, it was really right when a lot of markets started to become electronic, and that was a really interesting exposure to TradFi in those days, and kind of was there for a bit on one of the early HFT teams, and then joined another fund where I actually built out an HFT business from scratch, kind of within a larger fund. So anyway, so that was kind of the starting point. And then interestingly enough, right, like I left trading for a long time and wasn't expecting to come back to it, which in a way now we're building a platform for trading. But I kind of spent a bunch of time in Silicon Valley and working on startups around AI and fintech, and definitely followed the crypto space from the sidelines, made a couple of investments and read a bunch of the white papers, but didn't really start building there until the last 2-3 years. So it's interesting to kind of be back in a way where it started, which is, trading in markets. Of course, from a very different perspective, but hopefully some of those experiences have been relevant to what we're building now.
I know that Lighter is in many ways a pivot of the business that you were running. Much of the core team has stayed together and was actually an evolution of a lot of the side projects that the team was working on outside of the main business. Can you talk a little bit about maybe where the idea for Lighter crystallized, when it crystallized, and as you and your team were looking at sort of all the problems to be solved, what ultimate problem are you trying to solve with Lighter?
We started, like I mentioned, up until 2022, we certainly paid a lot of attention to the crypto space, but more from the sidelines. And we were kind of working on a different product in the AI space up until then. And a lot of the team was doing various stuff, either research or building side projects or trading kind of in and around digital assets or Ethereum or zero knowledge proof. So yeah, we had some of the ingredients, both in terms of kind of the talent on the team and some of what they've already been exploring on the side. And so yeah, we had supportive investors who really let us take a very significant pivot and start exploring the space and experimenting and kind of building with the resources and the team we had. But in terms of why we ended up where we did, I think the problem is, if you zoom out, right, it's like we have all these digital assets that represent decentralized protocols. The future of finance is a big part of what that's all about, right? Yet, at least in 2022, like 99% of how they were traded is actually in a centralized way, which to us, that didn't seem to make a whole lot of sense, right? Like you have all these new technologies for the future of finance, but the most important financial function, which is how to trade these assets, was actually done in a way that, to some extent, not only was it not leveraging the new technologies, but it was maybe even less transparent than TradFi, right? So like, as we saw with cases like FTX. So it's like, okay, well, can we actually build, an exchange that has all the good things you want that have been there on the centralized side, like low cost, low latency, and so on, while actually built with kind of the ethos of security and verifiability and transparency, which was kind of the whole point of DeFi. And that was kind of the idea, right? And the specific form factor of the product evolved as we started building and specific technical decisions were made. But I think ultimately it was just like pretty basic realization, right? It's like there are all these new technologies all the way from Bitcoin to zero knowledge proofs. Like, why aren't we using them for the biggest application of all, which is the future of finance, which is trading?
So let's talk about sort of the infrastructure it takes to make all that happen. And I want to take a big step back here because I recognize I don't expect all of my listeners, particularly those coming from the traditional finance background, to necessarily know what all these blockchain terms are that are critical to the actual infrastructure of a decentralized exchange like you're building with Lighter. So I want to take a step back, and I was hoping you could describe Lighter's architecture from a high level. What is an L2 structure? What role does a sequencer play? What are zero knowledge proofs? Why are they so relevant in what you're building? And maybe you could walk us through these component pieces as best you can for someone maybe who these are new terms to them.
Sure. Yeah. So when you look at these architecture choices, right, like Ethereum has an interesting architecture where it has the base layer, right, kind of the actual Ethereum L1, which is very secure, very reliable. It hasn't, I think it's been kind of over 10 years that it really had any kind of problem. And that's kind of what you want as the underlying layer in terms of security and verifiability for an important project that kind of actually touches money and significant assets. And I mean, I think one thing about that, right, even with all the other constraints that has introduced, right, like the Ethereum L1 still, I think even to this day, has the most TVL and DeFi applications. So even with the high costs and the throughput constraints, it's still the most significant L1 when it comes to DeFi. And the reason for that, I think, is because it's the most secure and it's kind of worked for a long time and it's trusted. somewhere where you would kind of trust with significant assets. But what's interesting is then you can kind of have a layer above that, which is kind of the layer 2. The various L2s can live on top of Ethereum. And I think some of those are pretty familiar, like Arbitrum, ZK Sync, Base, and so on. And so a layer 2 essentially operates in a way where there's a native bridge for assets between the L1 and the L2. And so let's say you have something like USDC, right? Like you can move the USDC from Ethereum to the L2 natively, and then the L2 potentially can have kind of a much shorter block size and can have kind of higher TPS and do operations with higher throughput than the L1, but then it inherits the security. And that can mean different things, right? Whether there's basically like optimistic L2s and ZK L2s, because we don't have to go into all those details, but we've certainly made the decision that ZK is the much more robust solution here. And the L2, you can think of it as its own chain in a way, right? But then the L2, for assets to actually move between the L1 and the L2, there have to be proofs that the L2 is operating correctly, right? And that's where the ZK part comes in. So Ethereum doesn't need to know everything that the L2 did, but Ethereum needs to know that there's a proof that that was done correctly. And the rules of what correct means are described in kind of so-called ZK circuits, right? So the sequencer is the part of the L2 that essentially sequences all the operations that happened in order and kind of the changes of state. Okay, like this, there's a new deposit that came in. Here's a new order that came in. The buy and the sell order were matched and so on, right? And all of that has to follow rules of the exchange. And those rules are made public. And in fact, like anyone can verify that what the L2 did complied with the rules of those circuits. If it didn't, then it's kind of stops being linked in a way to the Ethereum L1. And we actually have something called an escape hatch, which means that if something like that happens and it's not fixed quickly, then users can actually take their capital out directly from Ethereum. That's a very kind of strong security guarantee, right? Because it means if it screws up, it can't kind of take the capital with it, right? Users actually have a right to take their capital back out from the Ethereum layer. But essentially, the L2 can operate very efficiently. One way to think about it is like in TradFi, right? Like you can run an HFT desk that does millions of trades a day, but then there's kind of the accounting department that makes sure all of those are settled correctly at the end of the day. So, I mean, that's not a perfect analogy, but it's like the L2 can handle very high throughput, at low cost. But in our case, it happens like once an hour or so, and we're reducing that time further. But right now, it's about once an hour that the proofs are published with about an hour lag. The proofs are published on Ethereum. And until that happens, those transactions aren't actually proved to be correct yet. So you can operate very quickly, but then whatever you do is backed up by the most secure layer 1.
So would it be fair to say, to try to summarize all that, you have your generic blockchain, in this case, Ethereum being the L1. You can then have your own hyper-specialized blockchain. And in this case, that's the L2, lighter being the L2 structure, specialized to a particular use case. Because it's a layer 2 blockchain, it has interoperability and some security benefits that it inherits from the L1, but it needs to publish its actions back to the L1. And so you have the sequencer, which is basically allowing the L2 to operate, and then it's the zero knowledge proofs that you're publishing back to the L1 to say, we did what we said we're going to do, and this is where the L2 stands, and that's how you inherit all the benefits from the L1. Is that sort of a fair summary of what you're saying?
Yeah, that's a fair summary. Just to clarify, right? Like zero knowledge proofs, there are two things you get from that. One is privacy, but the one that we actually use is succinctness, right? And that part means that you can have a proof like that a million things all happened correctly. The proof of that can be very short. And so, for example, if hundreds of thousands of orders get sent in and many of them are canceled, many of them are matched, you don't need to publish every single one of those back to Ethereum, just a proof that it all happened correctly. Because if you have to publish all of that to Ethereum, you're not really gaining anything. Then you're still kind of subject to the bottlenecks of the L1. But what the ZK part gives you is that you can really compress a lot of that information while still maintaining its verifiability.
So maybe we can attack this from another angle, which I think is really important. But Why choose an L2 on Ethereum versus, say, launching your own standalone specialized L1 as others have done? Like, why build this on top of Ethereum versus just building your own later L1? What do you gain? What are the constraints you accept? Ultimately, what are the trade-offs that you see here?
I've mentioned this in one of the AMAs we did, which is a bit of a flippant answer, but like, it's like if you're running this highly specialized L2 top of Ethereum with all the proofs and everything, like if you didn't do any of those proofs, it would just be an L1, right? So it's like making it work as an L2 on top of Ethereum is to some extent the hard part. Not having that, then you just lose the security, you lose the composability, and you just keep the good performance. So I think what others have generally done and who've taken that architecture is like introduce other ways to get some form of verifiability or security, which is like having multiple nodes, having some consensus mechanism. Because if you don't have any of that and you're just running your own L1 and that's not backed by anything, I mean, Ethereum is like the most secure L1. If the L2 has no connection to that and no other ways of ensuring security and verifiability, at that point, you're not that different from a centralized exchange, right? Then like, for example, if that sequencer stops working, then that's it, right? Like no user can get their money back. Like it's pretty scary in that case. So what we gain is it's like by using this L2, L1 approach, not only do we gain some amount of security, we actually get the most amount, right? Like we immediately inherit what Ethereum has. And the ZK is what makes sure it's verifiable. So from our perspective, it's like, it makes a lot of sense to do it this way. The reasons, I guess, not to do it that way is, I mean, it's technically a hard problem. Like it took us 18 months to build it this way. Like if we were just building an L1 without the hard part of making it work on top of Ethereum, we probably could have done that in 6 months, right? So I think that's one thing you lose. And I think some people say like, well, it's better to have your own L1 because then you can have your own ecosystem around it. There may be some merit to the argument. I mean, I think we're building in DeFi, right? And isn't it much better to plug into the ecosystem that already has by far the biggest DeFi? It's like 120 billion of TVL in DeFi already, right? So it's like, it's much better to plug into that than rebuild it from scratch. So I actually don't really buy that argument, but that is, I should acknowledge that's an argument some people make. I think for us, the only reason we wouldn't have done it the way we did is just because it is a hard technical lift and it took a while, but we kind of solved the hard part first.
Let's talk about that hard part, which is these ZK proofs. And again, this is going to be something that's very unfamiliar to most people in traditional finance, was unfamiliar to me until I really spent some time with them. Can you explain maybe in like practical terms, ZK proofs, ZK circuits? You touched a little bit on why this could be such a powerful feature for a centralized exchange, but can you talk about like maybe in practice what they are, how this operates, and why they're such an important part of your architecture?
Right. So a couple of things, right? It's like, how does an L2 actually make sure that what it's doing is, because the L2 is operating at a kind of higher frequency, right, than the underlying L1. So you need some mechanism. You can't just update the L1 every time you do something, right? So you need to be some mechanism to link the two. And so there's kind of the optimistic rollup way, which is you kind of assume that everyone is doing the right thing. And then you kind of have like 7 days to prove that there is a problem, right? So that's why like those bridges take so long. I mean, the ZK way of doing it is much better. I think what most projects have been doing is building kind of a full so-called ZK VM, right? So which means like you can actually write smart contract code on the L2 the same way as you would on Ethereum. And then that code is kind of translated into these circuits. And what a circuit is basically like logical constraints. It's like something like, okay, like the price has to be above zero. I mean, that's a very simple constraint, right? Or like any kind of rule, right? Where like first in, first out, or time, price, priority, like all those kinds of rules are described. Think of it as like a long Boolean constraint. And so you could write any code in any language in this way if you want. It's just that if you want to support arbitrary smart contract code, it becomes very expensive to generate the proofs. And so that's why like the ZK EVM based L2s have actually, even though I think in principle they're much more efficient than the optimistic ones, like in practice, they've actually been a bit slow to market adoption. Now, our insight here was that, well, we don't need a full general purpose computer here, right? We just need to do the operations you need for trading and prove those, which is like part of that is matching buyers and sellers. But that's still a lot. If you architect that efficiently, it's still a lot more optimized than kind of a full-blown computer, right? So it's like we're just proving those parts that are relevant for finance. So it's an L2 that uses custom ZK circuits to prove just what you need to do finance, essentially. And I think that's kind of the way to think about the lighter L2.
How do you ensure when you're designing these circuits that you capture all the proof edge cases for the exchange's risk management? Is there sort of a formal verification language? Is it an audit? Is it an iterative testing process? Do you hire gray hat hackers to try to break the proofs? How do you actually ensure that the proofs are capturing all the edge cases and corner cases you need them to?
Right. So I think you've actually mentioned a lot of the relevant processes here as part of that. But yeah, I mean, there are definitely auditors here, and we've done an audit for kind of our initial circuits, and then now the circuits that have been around for months in the private beta and have been battle tested, we're getting those re-audited. So that's actually it. In fact, that's probably going to be done by the time that this episode goes out, because it's very close right now. So the audits are definitely part of it. Formal verification is something we haven't done yet, but we're looking at a few ways of doing that. Actually, talking to a few platforms on that. Probably will be done in the next couple of months. So there's definitely all of that. But I guess the part that is important to understand is the logic kind of lives in two places, right? I mean, it's in the circuits, but it's also in the sequencer, right? Which is essentially like, you can think of it as a very fast, almost like a centralized exchange, right? And so the sequencer is what actually kind of processes everything, and then proofs of that are generated, and then the proofs have to match what's in the circuits. So if there's any kind of inconsistency in terms of the rules, the circuits break, right? And then what happens is you can't publish the proof on Ethereum, and then no one can withdraw their funds. So because it's been running for over 6 months, all of those corner cases have been tested, because if any of them had broken, and I mean, it has happened a few times, and we've kind of had to quickly fix it. Like sometimes if users have seen that the withdrawal times are like go from 1 hour up to 3, 4, 5 hours. I mean, sometimes that's just from like congestion in the network, but from time to time that is because a bug was caught either on the circuits or the sequencer. But yeah, so there's already an ongoing, essentially like anytime Lighter operates, the rules are encoded both on the circuit side and the sequencer side. And if there's ever a mismatch, it has to be fixed right away. And so we've kind of processed billions of transactions, and the number of those corner cases that has come up has been pretty low, and it's gone down with time. So it's not just looking at the code or having expert auditors look at the code or doing formal verifications. Also, it's been kind of tested in real time through the actual trading.
One of the challenges that L2s often face is stake growth. And you mentioned you've done billions of transactions. There's, even in private beta, tens of thousands of users, a tremendous amount of volume each day. You need to keep track of every user's account. You have matching on the exchange. You have the margin and collateral to consider. And it seems like this is sort of an explosive stake growth issue that's only going to continue to grow. How do you manage this potential stake growth issue of the L2 while still expecting, I mean, this needs to be a very highly performant application?
Right. So we designed some novel data structures to do that. I guess for folks who want to go through the technical details, we have our white paper online, but essentially there's kind of this tree structure that at once serves as a way to store the order book efficiently, but the same tree can also be used to generate the essentially like Merkle proofs that go into the overall proof of the operation of the exchange. So yeah, I think that that's part of the innovation here. And this is what I meant, that we solved some of the hard problems first, which is like, can we actually have a data structure here that scales efficiently? And obviously there's some parts that scale linearly, and some parts like this data structure kind of scale in a way that's more efficient than linear. There's some cost to all this. I mean, we believe it's much more efficient than the alternative, which is why we've been able to kind of run the private beta with 0 fees. And even after that, there will be kind of low fees for certain types of trading. But yeah, there are some costs here. It's not completely free to generate all these proofs and process all the transactions, but we've designed it in a way from the beginning where we've designed some novel data structures that allow it to scale very efficiently.
If we go back to the beginning of the conversation, you mentioned that the problem that you and the team were effectively trying to solve with Lighter was, well, how do you create a truly decentralized exchange for trading all these native digital assets? And yet, one of the things that is true for Lighter as of today is that you have a private sequencer that is operating the L2. It's a closed source sequencer. And I think a lot of decentralization purists would argue, well, that's not true decentralization. So can you talk about the contrast of this idea of building a decentralized exchange while still having a private sequencer? What does this model give you? Again, what are the trade-offs? What are the pros and cons?
Right. I think one of the really interesting parts about ZK, right, is that it doesn't matter who's generating the proof. As long as the proof follows the rules of the circuits, which are public, you can confirm that all the different things like time, price, priority, and kind of the liquidation rules and all of those things happened correctly. It doesn't actually matter who's generating the proof. It could make sense to decentralize the sequencer, but we can actually achieve verifiability without doing that. But before we really dug in to the space, we thought about it as kind of decentralization end in itself. And then when we actually deconstructed, okay, what does that actually buy you, right? Like the thing is that you obviously want things like self-custody, but then what you really want for the operation of the exchange is verifiability of all the key operations of the exchange. You can actually achieve that with ZK. You can actually have some centralized components that are everything they're doing has to be proven. And again, it actually doesn't matter who's generating the proof as long as it's correct. Because otherwise, you do have to make some sacrifices on the performance side if you don't use that insight. And so kind of striking the right balance between getting the key aspects of verifiability right. You kind of want low cost, low latency while still being verifiable and secure. And so I can see some people might say, okay, you could do better across all of them. And if someone comes up with a better architecture, that's great. But I think some of the academic critiques come from people who are not actually that familiar with trading and what's important in trading, right? Like we have a lot of background kind of in both trading and cryptography. And so we're somewhat uniquely positioned to make those trade-offs because, like, for example, making sure the matching is fair, like that's very important. Because I think that there are maybe other systems that are decentralized in some other sense and maybe more so than we are, but then they allow for MEV, right? Which is like, that actually takes away a lot of what you want from fair matching. So it's like, which aspects are actually important to the operation of a trading and which components could a malicious operator cheat and cause economic damage, right? We want to make sure those parts are verifiable. There may be other aspects which academically are interesting to think about, but are actually not that important to trading. So again, I think if someone comes up with an architecture that's kind of better across the board, well, we'd be happy to take a look at that. But I think some of the academic critiques are not as relevant to kind of real world trading.
So what happens maybe at the extreme if someone does compromise your private sequencer, someone's able to hack it? What sort of is the extent of damage that's possible, and how is the infrastructure set up to hopefully limit that damage? I mean, could someone go as far as just draining the exchange if they get control of the sequencer?
No, they couldn't do that. If the proofs that it generates are incorrect in any way, and that could be out of 1 million bids and offers if a single one is matched incorrectly, right? It could be as simple as that, or it could be that everyone's account is drained. It doesn't matter how incorrect it is, right? But as long as there's anything incorrect in the proof, then the proof is not accepted by the smart contract that kind of sits on the Ethereum L1 and controls what the L2 is doing. And if that smart contract doesn't accept the proof, then none of those operations are valid. And it's like, at that point, the L2 is kind of living in its own parallel universe that's not actually tied to what the L1 knows, right? And so then after a certain amount of time, if the L2 doesn't fix the problem, then This is where the escape hatch comes in, then everyone can just take their capital out from the L1. The L2, if it were compromised, can think what it wants to think, but at the end of the day, you can still take out from Ethereum. So the L2 at that point is just meaningless, right? If it can't post its proofs on the L1.
So is it theoretically possible then that you could continue to run your own private sequencer and other parties could introduce their own private sequencers, or you could have a model where you progressively decentralize over time?
Right. Yeah, you can do that. I mean, the question is why, right? Because it's a hard technical lift to do that. And there's some reasons why it would make sense. For example, kind of if you want co-location, like you can imagine that. Because which parties would actually care the most about this? It's probably the market makers, the HFT shops. From the point of view of a retail trader, the current architecture works well and it's already very low latency. But if you want to optimize at the level of milliseconds or sub-millisecond, right? If you care about co-location, maybe there's a world where there are a few different sequencers that live in different geographies. And it's interesting, right? That we don't need consensus, like as long as any of them generate a correct proof. But still, it's not easy in terms of like, do we build that now or do we build other things that are really important to traders short term? Like I think we're prioritizing those other things, but yeah, I would imagine sometime in the next year or two, the kind of decentralized sequencer architecture will be on the roadmap. So it's definitely possible. It's just a question of priorities and which market participants really care about that. And perhaps some of those market participants will be part of figuring out what the solution looks like and kind of building it with our core team.
Strikes me as we discuss the architecture of the platform, how critical the ZK proofs or the ZK circuits, I guess, are to the integrity and ultimate security. And so my question here is, are these something that get frozen at a point in time, or are these editable, malleable circuits that in theory, some malicious actor could actually change the circuitry and hack the sequencer and be able to construct some sort of attack where they can escape with user funds, right? I mean, if they do get frozen, you have this issue of, well, what if the circuitry's wrong? How do you fix a bug? But if they're not frozen, how do you prevent someone from adjusting them maliciously, I guess is my question here. They seem so critical to the security.
Right. Well, I think that there's certainly parts here that not just the circuits, right, but the smart contract, kind of the code that lives on top of Ethereum that makes sure that the rules of the circuits are followed. There's some code that needs to operate on Ethereum, right? So that code, certainly, if that were compromised, there are some security. I guess no system is without risk, right? But like any Ethereum, any contract on Ethereum, you want to make sure there's no risk of that being compromised or very low risk of that. But that's one of the reasons why building on Ethereum is such a big advantage, right? Because there are a lot of best practices, a lot of developers, a lot of auditors, like these things. There are a lot of different ways to make sure that those core components that live on Ethereum are secure. The point is that someone would have to break in those core components, and those are on Ethereum. If the circuits themselves, I mean, we would get them kind of audited periodically. The circuits are public, right? So if somehow, if they were changed maliciously, like everyone would see that right away. So again, that's another advantage. I mean, no system is completely free from risk, but I think these components, A, the circuits are public, B, the core components that actually control funds going in and out live on top of Ethereum. Those are also smart contracts that can be audited multiple times. Like there are a lot of backstops here to the security, but of course we have to make sure that all of that is taken seriously, including kind of how our own team takes security.
I think you've addressed it tangentially, or at least maybe mentioned it head on, but I want to draw it out explicitly, which is a lot of concerns around L2s or alternative L1s is in the security of the bridging and withdrawal model. So can you talk a little bit about how this structure, how you think about preventing catastrophic asset loss as it relates to the bridge between Lighter and Ethereum or Arbitrum?
Right. So the native bridge is the Ethereum bridge, right? And so we have the deposit and the withdrawal there. I mean, the rules of those themselves are part of the ZK circuits. And so those follow the same security and verifiability architecture as the rest of the system. And I mean, over time, we may actually have kind of native USDC on the lighter L2, because right now the Arbitrum bridge kind of sits on top of that and kind of assets first. Like if you're bridging to Arbitrum, there's a mechanism where you kind of get the funds on Arbitrum first, and then on the back end, it's like it makes its way from the lighter L2 to Ethereum and then over to Arbitrum. And that system, I think, has been a good way for traders to do kind of fast withdrawals. I think we've reviewed the security of that as well, but a better architecture would be once we have native USDC, because then you can bypass that step, right? You can just go directly from, like, imagine if there was like a ZK circuit directly for USDC or another stablecoin. But in the case of USDC, right, you can actually just go directly from Lighter to Arbitrum, or basically any chain that has the kind of direct Circle integration. So we're kind of working on improving that bridging infrastructure. I think the current infrastructure has been well tested and audited, but there's certainly more that can be done there in terms of making withdrawals faster and being able to withdraw to other chains and so on.
I want to change gears a little bit and talk about other aspects of the platform. I want to spend some time a little bit on liquidity and some of the lessons you've learned in the private beta and how you're thinking about building out the actual platform structure. And I wanted to start with the lighter liquidity provider pool that you have, and is such an instrumental part in bootstrapping early liquidity onto the platform. And I think this is an innovation that traces its way back to maybe GMX and their GLP. I think Hyperliquid did this quite successfully. Maybe you can spend a minute just talking about what these pools are. But I'm curious, as you were thinking about deploying that pool initially and the evolution of that pool being so important to being counterparty to early liquidity on a platform, what sort of design choices were really important to you in ensuring sort of pool safety and capital efficiency and making sure that it was working as an efficient counterparty to all the early traders?
Right. I think here, to your point, we definitely learn a lot from other platforms. I think this is one of the cases where when we started building, we had an idea, and in this case, as I mentioned, like our team kind of had quant background. So we always looked at it like we can run some market making strategies to bootstrap liquidity in kind of the early days. But the idea of actually having the capital from the community itself be part of that was something that by the time that we built the core of Lighter, like that's become pretty well established in the space. So we definitely applied that idea as well, right? So we had some market making strategies already and kind of said, okay, let's like tie that into something. This idea of public pools where, in fact, actually any trader can run a pool, but starting out with the protocol based pool of the LLP. So I think there's just some kind of basic stuff you need to run making strategy. There are a number of good things about this, right? Like it was a really good test of the API, like where our own team was able to iterate on the API before bringing in other traders. Like I think it's also like a good flywheel, because when traders come in and they make money from allocating capital to the LLP, then they're happy about that. They might do more active trading with some of that capital. So it's kind of a nice flywheel. But in terms of like design choices, I mean, I think a lot of it is, how do you model liquidity? How do you model risk? Like when you list new assets, how much of the liquidity goes to the new asset versus how much stays on the majors? I think that there was kind of one issue earlier on where there was kind of more liquidity on some smaller perpetual markets. There was actually more liquidity on Lighter than on the underlying spot markets on Binance, and some bad actors were able to manipulate that. Now we kind of made the LLP holders whole from that incident and kind of adjusted the liquidity model going forward. So there are a few different types of manipulations that are possible, right? That one we were actually affected by. I mean, there are others that we built in protections for beforehand, and overall it's worked quite well. I mean, I think we were kind of surprised by how quickly the TVL of the LP has grown, actually.
So back in March, the hyperliquidity provider was subject to what was called the Jelly attack. This was an attack or at least as I understand it, a trader or a group of traders opened up through a couple different wallets, some long positions and some short positions. And then by aggressively buying the spot token across a bunch of different exchanges caused the market cap to jump up several 100%, which caused the short side on the perps on Hyperliquid to exceed platform liquidity. And that position ended up getting dumped onto the Hyperliquidity provider vault, creating an unrealized loss of 12 to 20 million. And this was sort of an attack vector that these liquidity pools can ultimately bear the burden of if they're not carefully designed. And so I'm curious, again, recognizing that this is a really important instrument for bootstrapping liquidity on a platform like Lighter, how have you tried to address these known risks and some of the unknown risks that go along with managing a pool like this?
Right. So the most basic one was having a liquidity model that takes into account how big these markets are on the spot side and as well as on other exchanges and kind of being reactive to that. A couple months ago, someone was asking the question, is our liquidity a function of liquidity on Hyperliquid, right? And that's one of the bigger exchanges. So it should be a function of all of them, right? Like if liquidity is low on Binance or Hyperliquid or anywhere else, that might be a cause to reduce risk in general, right? There might be something going on in the market. So I guess all of those things are factors, whether it's liquidity on the spot side or other futures markets. And I think kind of being conservative about that in general is a good thing, or kind of factoring in different kind of unusual price movement patterns. But in terms of like unknown unknowns, you can kind of go beyond that, right? And so, for example, kind of having isolated margin for newer markets, we're actually going to be adding some more markets that are less understood in terms of liquidity, like real world asset futures and pre-launch markets. And the plan is to have kind of a new pool for that. It's going to be called XLP, like experimental liquidity pool. And so XLP will kind of be isolated from the core LLP. And so that one is going to be kind of a higher risk, higher return pool, but it'll be a smaller amount of capital, right? But it's not going to be, will do the best it can to manage its liquidity, right? But if something goes wrong there, it wouldn't affect the core LLP. So that's something else we're doing. And I guess at the exchange level, for some of these less understood markets, we're also implementing open interest caps, which I think some of our users would have already seen for Linnea and or Liberty Finance. So I would say kind of, those couple of approaches.
You've been very deliberate, some might even say slow, in how you've opened up platform deposit size and API access. And some have argued that this has prevented skilled counterparties and market participants from really joining the platform. Maybe you can give some reasoning behind why you've sort of unfolded the platform as you have, and what do you expect to change when you do go fully public and open up access and increase deposit limits significantly for all parties?
Right. Well, we've had a lot of demand for API trading, and we've onboarded market makers and HFT trading firms, some cases small ones, but nonetheless actual trading firms to the API. Yeah, pretty deliberately. I wouldn't say that it's based on skill, meaning like some of the earliest ones to join are actually some of the most skilled market makers in the industry. It's more just based on how well we knew them, or can they be a trusted partner? Because obviously a lot of the stuff, the goal is to build it in a trustless way. But at the very early stage, you do want to, especially for API, right? You do want to work with kind of trusted partners that'll not exploit the system or do anything manipulative, and will kind of give consistent feedback and so on. But I would not say that it's not like we started with the least sophisticated market makers first or anything like that. Like I think some of the first ones we brought on are like in the top 10 biggest market makers on other exchanges. But yeah, I think the reason for doing this deliberately is just so that we can iron out different aspects of that system with trusted partners. I mean, it's very easy if you're doing programmatic trading and there is a vulnerability. Obviously, it's a lot faster to exploit it than if you're a retail trader. So we have to be extra careful here. But at this point, that universe has grown quite a bit. So I don't think there's going to be a dramatic shift to when we do the public launch. Like we have at this point, something like between 40 and 50 API traders that our team has onboarded and probably 100 more that have self-onboarded at this point.
As you continue to onboard more high-frequency traders and particularly market makers, can you talk to me a little bit about the role that you see the LLP playing in providing platform liquidity over the long run? And can you talk maybe a little bit about the market share that it represents today and sort of your expected market share over time?
I mean, I think right now it represents the lion's share of the liquidity still, like something in the neighborhood of 80%. That's going to go down with time. To your earlier point, right? Like some of the market makers that have joined, they have a lot of capital to deploy, but they've been kind of kept to deposit limits. And so they're not necessarily running at their full size yet. I think as that happens more and more, and as the fee structures for them solidified, like I think we'll see more activity there. So I could see a scenario where by the end of the year, LLP comes down to, 50% of liquidity or less. I mean, I think when it comes to markets that are, at least our expectation, right, is like when it comes to markets that are more experimental or newer, those will continue to be kind of bootstrapped through LLP. There's like one trading firm in particular that once we added the Yeezy meme coin, right, like they somehow are like very good at trading that one. So they actually came in and took most of the liquidity for that particular coin. So things like that might happen too, right? But I think in general, we do expect like that for new listings or kind of more experimental markets that will be still done more by the internal team, the protocol pools. And when it comes to the majors, more and more of that will be done by the professional market makers.
Your fee model, which is basically zero maker taker fees for retail and charging a fee for premium API tier that provides a latency advantage for high frequency traders, really stands out against industry peers, both on centralized exchanges and other decentralized exchanges. How did you settle on this model? And I'm curious if you can answer this both maybe philosophically, why you settled on this model, but also any sort of analytical evidence that you had that this was the right business model for generating revenue for Lighter.
I think this one, it is different from what's been the norm for the crypto exchanges. That's true. When you look at TradFi, right, like I think TradFi has actually moved more to this type of model through initially Robinhood and, others followed. And I was actually one of the first advisors to Robinhood, back 11, 12 years ago. So I kind of saw that firsthand. But also, even if you just look at like other industries, right, like usually the idea that the consumer part of the marketplace is kind of the hardest, most competitive to attract. And once you attract them, then it's the other side of the marketplace, the professional side that pays. Like, I think that's pretty standard, right? Like that's generally how advertising works, right? Like I think in TradFi, it generally works this way. So from like a historical perspective, I don't know exactly why that shift hasn't happened yet among crypto exchanges. It might be as simple as just someone introduced a fee model back in 2017 and others just copied it, right? But it doesn't seem to be the best long-term solution, since for us, the view is like, yeah, let's make like the lifeblood of the ecosystem is the trader, right? And like, let's make a great product for the trader. And that includes very low cost. I mean, I think for most cases, no, it's not, the fees are zero, there are trading fees are zero, there's another question of how do you distinguish an API trader from a retail trader, right? Like, and is it a question of latency only, or is it a question of the frequency of the trading? And those are the parts we're experimenting with, right? And there's also the liquidation fee part, which is not zero. And that's a factor as well. But in general, right, like I think the philosophy is that you want to have the best possible product for the retail trader. And then, the professional traders, for them, they're going to participate where they can make money, right? And if they're running a trading business and they make 100K trading on Lighter, and the fee structure, some fees are introduced where now they're making 80K, like they're still going to be there, right? That's kind of the view. And it might be new in this space, but it's actually how a lot of other markets work these days.
In other platforms, you often see for high volume makers or makers that are a significant percentage of platform volume, these rebates. I'm curious, given your current fee structure, do you expect any impact to long-term liquidity depth or stability, or the way in which you expect makers to behave on Lighter versus other platforms given these fee structure differentials?
Yeah, so going back to your earlier question too, right? I mean, I think part of it is like, I think the existence of the LLP is also a good forcing function here, right? Because, and the fact that it's very competitive among the makers, but I think like there's always going to be some liquidity from the LLP. So I think, we don't need any special deals with market makers around like they're guaranteeing liquidity at all times and things like that, right? Which is, I think, why some of these special deals exist right now. And in our case, it's like we want them to be successful and to trade on Lighter and make money, right? But it's like they certainly earn points through providing liquidity as well. So there are rewards on top of the trading profits, but like by and large, they're kind of free to come and go, and the opportunity to be profitable is seen as a reward in itself. There shouldn't be additional rebates on top of that.
The platform has been in private beta, I think, for a little over 8 months now. I know I personally joined, I think, late February 2025. So it's been a private beta for quite some time. But it's grown from, I think, when I joined till it was less than 300 people to now it's over 80,000 unique wallets connected. What have been some of your biggest surprises and learnings over this period?
On the positive side, right? Like, I think a lot of the organic growth has been definitely like faster than we expect. And we always had this philosophy that make sure that we stay close to the customers and iterate with them and take their feedback into account, and the rest will take care of itself. But we've seen that work firsthand, and actually I think it worked more effectively than we even expected, right? Where we haven't spent any money on marketing or engaged any agencies, anything like that. It's all been organic. And I think as a result of the community that we built and kind of the time and energy spent on making sure that customers are successful. So that's one thing. I mean, I think another positive things we've seen, like I think the growth of the LLP has been probably both in terms of the performance and how fast the TVL grows. Like both of those have been kind of surprising to the upside. I would say, again, I think theoretically we knew, okay, yeah, like market making obviously makes money and capital gravitates towards good returns, right? Like we knew those things, but how quickly that actually happens has been a surprise, right? Like LLP in the beginning, we like seeded it with 100K of funds from the protocol, right? And the rest has come in from within the community. Now that TVL is beyond 100 million. I guess in terms of like surprises that were negative, I mean, we had kind of an attack in March, kind of similar to the Jelly one. I think at that point we were a bit unprepared. I mean, I think we handled it well. And after that kind of built in some good mechanisms around those types of attacks. But that actually happened only like 6 weeks after we launched. So I guess that's kind of a common pattern. I feel like there are a lot of bad actors around, and there have been other attempts at attacks as well that haven't resulted in negative experiences for the users. But there's a lot of like bad actors, market manipulation, kind of hackers, DDoS type attacks, like a lot of stuff like that. So we weren't naive in terms of never expecting that to happen, but I think how early on in the life cycle we started to see those was maybe surprising. Yeah, I guess that's some of what comes to mind. I mean, by and large, I think the roadmap we had in mind early in the year, we've generally been able to follow. So there haven't been big surprises on the technical side, which is, I think, a good thing. But in terms of like on the side of how the product has actually worked in the market and the good and the bad, I would say that that's what comes to mind.
I want to take a step back as we approach the end of the conversation here and talk maybe a little bit about the ecosystem at large. We talked about the design of Lighter being a custom rollup to an L2. And I'm curious as to your thoughts. As more decentralized applications adopt this custom rollup philosophy instead of sharing space on, say, a general purpose L2, what happens to the composability which is one of DeFi's strong arguments, that a lot of these financial primitives are composable, these sort of money Lego building blocks. Don't you lose that benefit?
So for one thing, I think the composability that we're introducing here is kind of within the Ethereum ecosystem, right? Where now with Lighter, there's kind of a high performance perp DEX that's composable with other building blocks of DeFi, whether it's lending or staking or AMMs or other things that will be built in the future. It's not necessarily for a perp DEX to be composable with other perp DEXs. Like that's not, I think having composability across different financial applications in general opens up more opportunity, and you can really do a lot of interesting like financial engineering on chain with that. But the other thing is like composability between high liquidity DEXs is less needed, right? Because like that's what the professional market makers and arbitrators, they kind of already make that happen anyway, just through participating on a few exchanges. And I think that price discovery across those exchanges happens pretty quickly already. So I think to me, the really interesting unlock isn't so much like perp DEXs being composable with each other, but more like having a high performance perp DEX within this really large DeFi ecosystem on Ethereum.
So we started this whole conversation with you discussing the problem that you were looking to ultimately solve with Lighter. And you mentioned this phrase, the future of finance, which is often a phrase that gets used tongue in cheek, particularly on crypto Twitter, where someone's pointing out sort of the downfalls or the pitfalls of crypto. And I think a lot of skeptics would say that we don't need yet another venue for people to gamble on trading sardines. Like, why do we need perps on yet another meme coin? And I was hoping you could maybe, as best you can, look into the future and paint me a more optimistic picture of how DeFi and custom rollup L2s and composability and, a high-speed perp DEX is ultimately an unlock for global financial markets.
Right. So I think at the infrastructure layer, right, there's a lot of opportunity to kind of build something that combines the high performance that you want and then you need to do finance, right? Like low latency, low cost, a high throughput. I mean, you kind of want that, plus you want verifiability, you want security. So hopefully we've achieved kind of the right balance across all of those parameters to have kind of infrastructure that's kind of strong enough to support high performance finance while being backed by the most secure L1 in crypto, right? Which is Ethereum. So I guess like from the point of view, like why is a new product or new infrastructure needed now? Something like this hasn't existed before. We think we figured out kind of the right mix of ingredients here, but up till now, right, like none of the existing platforms would have supported in a world where kind of TradFi moves on chain, right? Like I don't think any of the existing, for example, like can you imagine high frequency trading happening on an AMM, right? Like I don't think that would make sense. Or can you imagine like very large amounts of capital that were for which security is very important, kind of living on top of a custom L1? That doesn't really make sense. So I mean, I think from the infrastructure perspective, this was certainly an unsolved problem, and we think we figured it out. But yeah, the solution doesn't stop at the level of a better casino, right? Like the idea is that once you have all this infrastructure, it can be used for greater universe of assets, and eventually that'll include real world assets. And you can have, like imagine something where you could trade and anyone could trade something like Tesla stock, right? While using, let's say, an investment in a liquid pool as collateral for that. Or you can kind of combine that with instruments like lending, right? Like if you think about all these things as they play out, you need that infrastructure first. And probably like the first application of the infrastructure is more on the side of, I think this generally happens with new technologies, right? Like usually the first users are more risk takers who are speculating on different things. And then over time, more institutions come into play. But you need that infrastructure first. So if you look farther out, like 3-5 years, you can certainly see a world where, assuming we're also moving in a good direction on other products being built on chain and kind of with good frameworks for regulation and all of that. I mean, I think we're starting to see what that world could look like of a TradFi and on-chain finance merging somewhere in the middle. So we don't know exactly what that would look like, but our view is if we have a really good solution at the infrastructure layer and we kind of build the liquidity flywheel and have a lot of users and continuing to add new features, then hopefully we'll kind of be kind of in that nexus once that future is realized.
One of the recent narratives I've seen kicking around quite a bit, well, really recently in August 2025, was this idea with Ethereum, which I think a lot of people have considered to be, I don't want to say by any means a dying chain, but something that is potentially not keeping up with Solana or Hyperliquid. But this idea that Ethereum with ZK rollups, you don't have to move assets anymore. You can move proofs. That through the combination of Ethereum as an L1, ZK rollup L2s, that you can keep your assets safe on Ethereum and just migrate proofs up and down to L2s. And I'm curious what your thoughts are on that model. Again, going back to the ability to use different DeFi primitives as composable components of a larger financial engineering architecture, or even just something as simple as using them as collateral on something like Lighter. Is this something that your team has investigated and is thinking about?
Yeah, absolutely. I mean, this is kind of one of the applications of composability that I think we're most excited about, right? Is like any asset that already lives on Ethereum being able to serve as collateral on Lighter without really having to move anywhere, right? But where, for example, like if there's a liquidation, the way that would be processed is kind of through a ZK proof that ties the L1 and the L2 together. So yeah, absolutely. I mean, I think that's a good framing. And from my perspective, right, like the only downside of Ethereum has been on the performance, right? Like it's, if you just use the L1 for finance, it's slow and it's expensive. Now it is secure, verifiable, and composable. But what's interesting, right, even with the performance limitations, it still has by far the most capital in DeFi. And so it's like if you now with the use of ZK proofs and kind of the really leveraging the L2 architecture, if then you actually also get high performance, then I think the Ethereum ecosystem has a really optimistic future, given that how well it's already done, even with those limitations. And now you can actually have something that's as high performance as anything in the centralized world while retaining the security and the verifiability. To me, like that's kind of the magical part of all the ZK stuff.
All right, I want to ask you the same question that I ask everyone at the end of this season, though I recognize you are incredibly busy, so I'm not sure you have time for obsessions. But my question is, outside of work, what are you currently obsessed with? This could be an idea, this could be a hobby, a book, music, a show, just something that's really caught your attention and you're currently obsessed with.
I don't know if this is like a very recent one, but ever since the pandemic, I've really been getting into chess. And I think part of it is just fun. I mean, there are also some interesting applications of, I think that the chess AIs are getting much better, and it ties into some of my other interests on the technical side, but even just getting back into the game itself. And that's been a lot of fun the last year or two.
Vlad, thank you so much for joining me. I really appreciate your time.
Thank you so much, Corey.